Hey everyone, welcome back to Corporate Decoder, the place where we unravel the complex world of corporate finances. And today we're diving into Asbury Automotive Group's 10K filing for the year ending the 31st of December 2025. From acquisitions to risks, they've certainly navigated a busy year. And we're going to break down what their numbers actually mean for the business. Before we jump in, if you love getting these kinds of insights directly from the source, make sure you are subscribed. And hey, if you want to connect with other finance enthusiasts and get even more exclusive content, join our Discord community. It is linked right down below. So Asbury Automotive Group, a big player in the automotive retail scene, has released its annual report. They're a Fortune 500 company operating a ton of dealerships and collision centers across 15 states, plus a finance and insurance provider called Total Care Auto, or TCA. Their mission is a mouthful, trying to be the most guessed centric automotive retailer. We will see how that plays out in the financials. A significant event this year was the acquisition of the Herb Chambers companies back in July for a hefty $1.76 billion. This deal added 33 dealerships and 52 franchises to their portfolio, expanding their reach into the Northeast. They also made a major move in 2023, acquiring the Jim Koons automotive companies for about $1.5 billion. These moves clearly show a strategy focused on growth through acquisition. But it wasn't all about buying in 2025. They divested quite a few franchises, selling 24 franchises across 15 dealership locations. They also sold off divisions in 2024 and 2023. These divestitures brought in significant gains, over $80 million pre-tax in 2025 alone. This suggests a strategy of both acquiring and optimizing their dealership network, selling off underperforming or non-core assets. Now, let's talk numbers. Total revenue for 2025 hit an impressive $18 billion, up 5% from 2024. This growth is largely driven by that big Herb Chambers acquisition, adding about $646 million in new vehicle revenue. The parts and service side also saw a nice 6% boost. Digging deeper into new vehicle revenue, it climbed by 7% to $9.5 billion. This was fueled by selling more units and a slight increase in the price per vault vehicle. However, here is where it gets interesting. While they sold more new cars, the profit margin on each new vehicle sold actually dropped by 7% from $3.7 thousand in 2024 to about $3.4 thousand in 2025. This is a trend to watch: more volume but lower profit per car, especially in the luxury and import segments. This decline is reflected in the total new vehicle gross profit, which fell by 3% to $621.9 million. So while the top line looks good, profitability per unit is under pressure. This could be due to increased competition or manufacturers adjusting their incentive programs. On the used vehicle front, things are a bit mixed. Total used vehicle revenue stayed relatively flat, around $5.2 billion. They saw a boost in wholesale used car sales, but retail used car sales dipped slightly. Interestingly, despite lower volumes, their profit margin on used cars is actually improving, up about 10% per vault vehicle. This shows they're getting smarter about acquiring and pricing their used inventory, focusing on profitability over just moving units. The parts and service department continues to be a strong performer, with gross profit increasing by 9% to $1.47 billion. This business is often more stable than vehicle sales, and it is great to see them growing it, likely due to more customers holding onto their cars longer and benefiting from more complex vehicle technology that requires specialized service. Overall, total gross profit grew by 4% to $3.07 billion. However, remember that dip in new vehicle gross profit. It means the overall gross profit margin slightly tightened to 17.1% from 17.2% last year. Not a huge change, but it highlights that pressure on new vehicle margins. Now, operating expenses, selling, general and administrative costs went up by 5% to nearly $2 billion. A big chunk of this increase is due to the Herb Chambers acquisition and higher professional and legal fees related to that deal. And their technology upgrades, their SG&A as a percentage of gross profit also edged up slightly, which is something to keep an eye on. Despite the rise in SG&A, income from operations still managed to increase by 3% to $860.6 million, largely thanks to that boost in gross profit from their acquisitions and parts and service. After accounting for lower total other expenses, which was significantly impacted by a huge jump in gains from selling dealerships, income before taxes jumped by 15% to $662.2 million. Taxes also went up, and in the end, their net income rose by a solid 14% to $492 million. When companies grow through acquisitions like Asbury has, a lot of the purchase price often gets allocated to something called goodwill. For auto dealerships, they also recognize franchise rights as a major intangible asset. Asbury has a whopping $2.3 billion in goodwill and another $2.1 billion in franchise rights on their books. They have to test these for impairment annually, meaning if the value of a dealership or their overall business drops, they might have to write down these assets, which hits their earnings. They did record some asset impairments this year, mainly affecting franchise rights, which is a reminder that these acquisitions aren't always smooth sailing. Here is where things get tricky. The valuation of these manufacturer franchise rights is complex. Asbury uses discounted cash flow models, which rely on estimations about future profits. Factors like future earnings before interest, taxes, depreciation, and amortization, or EBITDA and the cost of borrowing money, or weighted average cost of capital are all forward-looking and subject to change. The auditors noted that assessing these valuations involves significant judgment and complexity, which is always a flag to pay attention to. Let's talk risks. Asbury faces a lot. Disruptions in vehicle production due to supply chain issues are a major concern, as they rely heavily on manufacturers for inventory. Property loss from natural disasters is also a risk, as they saw with hurricanes impacting stores in 2024. Integrating acquisitions is another big one, with potential for higher expenses and difficulties in realizing expected benefits. They are also heavily dependent on their relationships with car manufacturers, who can impose restrictions and significant influence over their operations. And then there is the debt. As of the 31st of December 2025, Asbury had over $3.5 billion in total debt, plus another $2 billion in floor plan notes payable. This is a massive amount, while they are currently compliant with their debt covenants. This level of debt could limit their future flexibility and make them vulnerable to economic downturns or rising interest rates. A 1% increase in interest rates, for example, could cost them an extra $26 million in annual interest expense. Overall, so what is the story here? Asbury Automotive Group is a growth-oriented company actively using acquisitions to expand its footprint. They're seeing revenue growth, particularly from new vehicle sales and a strong parts and service division. However, the profit margins on new vehicles are under pressure, and the company carries a significant amount of debt. While their strategy of optimizing their dealership portfolio through divestitures and focusing on profitability in used cars is smart, the high debt levels and reliance on manufacturers for success are notable risks. The integration of the recent large acquisition, Herb Chambers, will be key to watch to see if they can achieve the expected synergies without running into significant cost overruns or operational disruptions. Overall, it is a company making bold moves in a competitive market, but the financial structure warrants careful consideration. That is our take on Asbury Automotive Group's 2025 annual report. What do you think about their growth strategy and those debt levels? Let us know your thoughts in the comments below. If you found this breakdown helpful, please smash that like button. It really helps us out. And make sure you are subscribed so you don't miss our future corporate deep dives. Don't forget to join our Discord community linked in the description for more insights and discussions. Thanks for watching. And we'll see you in the next one.